Hello everybody and welcome to our webinar today on Employing People, the Essentials for Employers. This webinar follows on from the Employing People webinar 1, which looked at who need to be employed and how to employ them. So we'll take a look at what today's webinar will cover. So under the Essentials for Employers, we're going to look at the options for payroll systems and how to set up a payroll. We'll then briefly look at tax and national insurance, and then we'll finish with some handy hints and tips for various aspects of employing people. So to make a start then on payroll. There are various options for payroll packages, and I've summarised the main three here. So firstly, we've got the HMRC Basic PAYE tool. Then we've got using an accountant or bookkeeper. And finally, using an off-the-shelf package, many of which are now becoming cloud-based following the Making Tax digital move. So what we're going to do as part of this webinar is take a look at each one in turn and cover the advantages and disadvantages of each system. It's worth noting at this point that there are advantages and disadvantages for every system. And in terms of what payroll system works best for each business is entirely business dependent, depending on what is going on within your business, how many employees you've got, and what the whether you're quite computer literate and are happy to do things on computer, or whether you prefer to have support from others, are just some of the things that can affect which payroll package you use. So firstly then, we'll take a look at the HMRC Basic PAYE tool. So this is a program that is downloaded from the internet and it's saved as software on your own PC. It's designed for businesses with less than 9 employees. The big advantage here is that it's free to use, so it's entirely free. It's purely a case of downloading software. There's no subscription charges or anything like that. And it can carry out most of the basic features you need in order to do your payroll. So for example, a calculator to work out employees' tax and national insurance contributions, or any student loan deductions that were needed. So it is a highly cost-effective tool for small businesses, but there are two major drawbacks when it comes to the HMRC Basic PAYE tool. And the first one is that it cannot currently produce a payslip. So it doesn't produce a formal payslip that shows the amount paid, the deductions made, and gross pay as well. So therefore, a lot of people that are using this system currently are using another system or an Excel spreadsheet to create their own pay slips to give to employees, or some have a carbon copy book as well that they use. So there's different systems in place there, but it's worth noting that an official pay slip cannot currently be produced from this system. It is hoped this might come in to force in April 2020 and the feature will be added to the programme, but I can't confirm that at this stage. The other major drawback is that it's not a programme that can cater for auto-enrolment or pension contributions. So we'll cover pension auto-enrolment later on, but it's worth noting that it is now a duty of employers, and some payroll systems you can link your pensions and your auto-enrolment duties to your payroll system, so therefore doing everything on the one system, but you can't do that with the HMRC Basic PAYE tool. You can't auto-enroll staff onto pensions, and you also can't submit what your pension contributions are to your pension provider as part of this tool. So therefore you would need to have a separate tool. Most people maybe go onto the website of their pension provider and just type the information directly into that, but it's worth noting it does involve going into a separate system. Payroll and pensions can't link using the HMRC Basic PAYE tool. So then to move on and look at the second option for payroll systems, and that is using an accountant or bookkeeper. So again, we'll just look at the advantages and disadvantages of this system. So key advantage is that it's a good approach if you're not confident with a computer. It doesn't rely so much on you having strong computer literacy skills. It takes a bit of the onus off yourself. You obviously still need to provide a certain level of information to your accountant, but they can then help complete the process and do the reporting for you from there. So therefore, it can be an easier method if you're a bit pushed for time, as you don't need to complete the whole process from start to finish. You can, do the first step and then let your accountant take over from there on your behalf. Many people like about an accountant or a bookkeeper is that they're likely to be more familiar with the legislation and therefore help keep you compliant. So there may be changes to employment legislation, and if you're using an accountant or bookkeeper, they would flag these up to you as these changes come into effect, and therefore save you having to try and keep up on top of everything. Using accountancy firms can be a more expensive method, certainly in comparison to our HMRC Basic PAYE tool that we looked at, which is entirely free and purely a computer download. It will take, there will be more costs involved in using your accountant, but obviously it depends on each accountant and what system you've got set up there. Our other two options out of the three for payroll today are all computer programs and therefore are available anytime. Whereas when you're using an accountant or bookkeeper, you are restricted to office hours. So therefore you would need to contact your accountant during working hours to be able to discuss your payroll with them. So that's one feature that some people don't particularly like. Sometimes they like to be able to do things at a time that suits them rather than being bound or restricted to certain hours. So what we're then going to move on to look at is our final payroll option, which is off-the-shelf packages. These packages are normally cloud-based nowadays following the move to making tax digital. So the key advantages on these either standalone or cloud-based packages that you can buy, then they are much more automated and integrated. So many of the calculations are carried out automatically. And also your reporting and your end of tax year requirements, they can be produced and reported automatically as the systems have the ability to link up to many other systems. Another positive that many people like is that there is software available which can do your accounts and payroll at the same time. And this therefore keeps everything in the one system. So once you get to know one system, you know it well. It saves you having to learn a system for your accounts and a separate system for your payroll. Unlike the HMRC Basic PAYE tool, this tool can generate payslips, and in most cases, if your employee email addresses are added to the system, then it can automatically email those payslips to employees. A big advantage that I think of these systems is that you can add an advisor or an accountant to your account on these packages so they can assist you if you have any problems. So for farming businesses, it's akin to your rural payments and services account that you have with Scripid, and you can add advisors and such like to that as agents, and therefore we can see what you can see. And that's exactly the same with these off-the-shelf packages. Is you can add that advisor or accountant, and therefore they will be able to access the same information that you can. And therefore, if you ever did get into a bit of trouble using the application, it would be another person that you could phone to help you track back where you had gone wrong. And unlike your accountant or bookkeeper that's restricted to office hours, this can be accessed anywhere, anytime. However, with that, there are also drawbacks, and that is that computer literacy skills are required. Obviously, you do need to learn how to use these systems, and some people might be quite computer literate and happy to learn how to work a new system, but others won't be, and that's maybe some situations where your accountant or bookkeeper would be a preferred method. There is also a subscription charge for these off-the-shelf packages, which is not the case with the HMRC Basic PAYE tool. It depends on what level of subscription you take out and what the needs and demands of your business are, what subscription charge that will be. But I know some people have been hearing that some people have been finding it can be quite an expensive subscription charge depending on what level of package they choose to go with. And finally, the drawback is that it does require internet access. So it is an online programme, so therefore there will be internet access required. So that is the three main options that you've got for payroll, and I'll look at some of the advantages and disadvantages to allow you to make your decision as to what option may be most suitable for yourself. So following on from a look at the three options, we'll then look at what we would need to do to set up payroll. So setting up payroll. When you first go to set up a payroll system, you require the following information. Employee details, and the easiest way to gather those is if the employee has left another job before starting work with you, is to get a copy of their P45, and that will have all the information in one place. However, not all employees may have that, or many people are starting to employ people through a modern apprenticeship programme, and therefore a P45 won't be available. So therefore, I would recommend you use the new starter checklist from HMRC's website. In support of this webinar, on the Farm Advisory Service website, which is www.fas.scot, there are a number of other supporting employing people materials. And one of those materials is a series of web links. And one of the web links that's available on the website is the link to that new starter checklist from HMRC. So all you simply need to do is go on to the Farm Advisory Service website. There'll be a blue toolbar that'll open along the top. And on that, if you select rural business. And once you've selected rural business, then a box named employing people will appear. And from there you can access the web links, but also many practical guides, videos, and a host of other information there to help you in your employing people process. Once you've got your employees set up and you come to pay them for the first time, you're required to submit a full payment submission. So this is to register the employee with HMRC. So in webinar 1 of Employing People, we covered how you need to register yourself as an employer with HMRC as step 2 of the 6 steps of employing people. But now we're coming to near the end of the process and you have registered yourself as an employer, but you now need to register that employee with yourself. And that's done by submitting that full payment submission. And what that includes is information that you've collected from your employee in step 1 of employee details, and it'll also be the pay and deductions since they have started working for you. So for example, what they've been paid and what tax and national insurance has been deducted is what goes on that full payment submission. As the final step to setting up payroll, I've included Nest pensions information. I've picked Nest as a particular example as during this topic in the meetings and webinars associated with it, I've had many people asking me what pension systems most people use. And in agriculture, it probably is most commonly Nest pensions. And it's a pension scheme that was set up for auto-enrolment and workplace pensions. And it is quite effective, and it's probably the one that most commonly people will use. If you're using systems that can link payroll and pensions, then as part of setting up your payroll, you would be required to give pensions information. So that would be what date did you want pension contributions to go to, and a bit of information about your employee in relation to auto-enrolment and pensions. So that would be integrated into the setting up of the payroll. Whereas for systems that can't cater for pensions auto-enrolment, then you would need to do that. You would still need to set up pensions, but you would need to do it in a different system or the pension provider's website. Just a small note then on payroll records. If HMRC wish to investigate that you are paying the right amount of tax, these would be the records that they would ask for. So they would ask to see what employees are paid and what deductions have been made, the reports and payments that you make to HMRC, employee leave and sickness absences, tax code notices, and any taxable expenses or benefits. So the taxable expenses or benefits won't apply to all businesses, but it is worth noting that if there is additional benefit that your employee is being provided that is taxable, then HMRC would ask to see a note of that. And for all those records there, you must keep them for 3 years from the end of the tax year they relate to. And although not distinctly linked to payroll, timesheets are another record that must be kept, and they are also for the same 3-year period. So 3 years is a good term to remember if you can. It relates to how long payroll records and timesheets should be kept for. However, it is probably worth noting at this stage that if you were ever to be taken to an employment tribunal, they would ask to go back 6 years. So it's 3 years in most cases, but just do note that if that situation was ever to arise, they would ask to go back 6 years. So that's really brought us to the end of your options for payroll systems and how to set up a payroll, which was topic 1 of today's webinar. So with that note, we will move on to topic 2, which was tax and national insurance. So to begin with, we're going to look at income tax. So the same rate of tax is not paid on everything that an employee earns, and that will become more clear in the next slide I'm about to put up. But to begin with, let's note that every employee will have a personal allowance, and this is the amount of income that can be earned before they pay tax. And currently that sits at £12,500. So if we take a look at the example on the next slide to make that clearer, this shows our 2019-20 income tax rates and bands. And on the right hand side, we've got an example for an employee earning £25,000 per year. So they get charged no income tax on the first £12,500 of their earnings, as that is their personal allowance. They then enter into the starter rate tax band of 19% for the next £2,049 of their income, and that's until they've maxed out that band, as the upper earnings limit for that band is £14,549. So at that point, they move up to the next rate of 20%, and that comes on the largest chunk of their earnings at £10,395. And that is again until they have maxed out the income band for that tax rate. And at that point, there's only £56 of their earnings remaining, and income tax is charged at the higher rate again of 21% on that. So all really payroll systems will have calculators that will be working this out for you, and therefore it should make it much easier for yourself. But it was just to have a look at the background of how income tax is calculated, purely for reference and understanding. So at that point, we'll go on to look at national insurance. So national insurance is taken from an employee's pay each period. So for example, for most that would probably be monthly. So when we looked at income tax, we had the personal allowance. When it comes to national insurance, we have the lower earnings limit. And it's the same principle, that national insurance deductions are only taken on earnings that are above the lower earnings limit, which at the moment is £6,136 per year. And you can see on the screen there that's split down to what it would be per week and what it would be per month. So if an employee's earnings are above that level, then they will be required to pay Class 1 or primary contributions. So they are deducted from an employee's wage before they receive the wage and paid to HMRC via PAYE. The one thing to note about your Class 1 or primary contributions is they are dependent on the level of income, similar to what income tax was. So when an employee's pay is between £166 and a penny and £962 a week, the national insurance rate is 12%. But once earnings are anywhere above that £962 a week or £4,617 a month, the national insurance rate reduces to 2%. So the main point to highlight here is that in Class 1 or primary contributions, there are two rates of national insurance. So this is the employee's contributions, but national insurance also requires an employer's contribution to be paid, and that can also be called secondary contributions. And again, it's paid to HMRC as part of your PAYE bill. But it's worth noting that unlike employees' national insurance, there isn't the two rates. So once employees' pay has reached above the lower earnings limit, all secondary or employer's national insurance is charged at 13.8%. However, employers are entitled to an employment allowance. So this is an allowance that reduces those employers or secondary contributions each time you run your payroll. So with this allowance, you have a maximum of £3,000 per tax year. And that £3,000 either runs out when you've claimed it all back in reductions to your contributions, or the tax year ends, whichever is sooner. So there's no carryover process if you've not claimed it all back in deductions by the time the tax year ends. You purely stop at that point and start in the new tax year with a new £3,000. You only need to claim employment allowance once through your payroll software or package, and your claim will continue until you choose to stop it. So on most payroll packages, there'll be a question or a statement quite often near the start of the setup process that will ask if you're entitled to employment allowance, or it'll use a similar name to it for that. And at that point, you would be looking to either answer yes or tick a box. And that would initiate your claim, and that claim would continue until you chose to stop it. What we'll now take a look at is some key facts and maybe confusion in relation to employment allowance. So there are situations where some people think they should be selecting no in the employment allowance indicator field, or they should be returning and changing it to no or unticking the box in an employer payment summary. However, it's most commonly where errors arise. So we'll just cover through these now. So say for example you have reached that £3,000 limit before the end of the tax year. So you've had your £3,000 all back in reductions to your contributions. That does not make you ineligible. It just means you've got everything you're going to get for that tax year. But what you don't want to do is go back is untick that box in an employer payment summary, because what it will mean is you could end up in a situation where you end up having to pay back what you had received in deductions to contributions if you then mark yourself as ineligible. So it's not that, if you keep ticking that box, you're going to get more than your £3,000. That's not going to happen. Once your limit's reached, your limit's reached. But keep the box ticked, and then when the new tax year starts, you'll get a new £3,000 again. The other situation is where businesses only had one employee and that employee left. How to deal with this situation is to wait until the start of the new tax year before you untick the box in your employer payment summary. And that is purely because, let's say for example, the employee left in December. If you untick the box too early, then you will end up in a situation where you might have to pay back those reductions you got between April and the December. So just wait until the new tax year starts and you refresh and then untick your allowance so that you then don't get that £3,000 starting with the new tax year. It's also very worth noting that you can backdate your employment allowance claims. So you can claim employment allowance for a previous tax year dating back to the 2015-16 tax year. So if you have missed this field, or you've not been claiming what you've been due, then you can backdate your claims, providing you could provide full payment submissions to HMRC. So obviously you can backdate to that 15-16 tax year, but the employment allowance for the tax year ending April 2016 was lower at £2,000. But there's still money there that can be claimed back if you have missed this and not been getting what you were due. Just a brief note then on tax and national insurance for seasonal and migrant workers. Depending on their earnings, it's likely that seasonal and migrant workers will have to pay both. So if they meet above the personal allowance and the lower earnings limit, they're likely to have to pay them. However, if they're only here for a short time and what they have paid by the time it's averaged out over the 12 months is too much, they will get a refund. This would probably happen anyway, but the easiest way to deal with employees that are seasonal and migrant workers, if they are leaving you and then leaving the UK, is just get them to submit the form at P85, leaving the UK, getting your tax right. And that is basically flagging up to HMRC that there is somebody there that needs checked, just to make sure they're not entitled to any refunds. You'll obviously be able to see that the link to the form is on this webinar, but it's also one of the web links on the Farm Advisory Service website. So I would recommend that following this webinar, you refer to that website to get much more information about what we've covered here today, but also what was covered in webinar 1 of employing people, which was who needs employed and how to employ them. If you couldn't join us on that webinar, then there is a wealth of information on the topics covered in that webinar on the website as well. So we'll just summarise what we've covered so far with a few key messages. So the key points to take away from this webinar are ensure that you're using the payroll system that is most effective for your business. So there's obviously no one payroll system that will suit everybody. Like I said, it depends on individual circumstances. But just make sure you've looked into the advantages and disadvantages of all the different systems and pick the one that is most suitable for yourself. If you're just looking to set up your payroll for the first time, I would highly recommend that you have all your employee information ready before you start. So whether it's a copy of the P45 or a completed new starter checklist that you've sent away with your new employee, whatever it may be, if you can have all that information gathered and in front of you before you start, it will make the process a lot more straightforward. Secondly, make sure all eligible employees are enrolled on a pension scheme. So we only briefly covered pensions today when looking at setting up a payroll, but webinar 1 did go into much more detail about auto-enrolment, who's eligible, who's not. So either watch the recording of webinar 1 or consult the website for some more links and information regarding pensions and auto-enrolment. And finally, make sure you're claiming employment allowance for national insurance. So, if you have missed that claim so far or missed that box, then do make sure you start claiming it and get the money you're entitled to. And on that note, we are just going to move on to topic 3 of the webinar, which was some frequently asked questions on employing people. Now, these frequently asked questions will relate to both the information that was covered in webinar 1 and the information that we've looked at so far in webinar 2. So it may be that we discuss some topics that we haven't directly introduced in this webinar, but hopefully you will be able to either understand the question and the topic, but if not, I recommend you consult the recording of webinar 1 first. So we'll take a look then at stable income arrangements. So I've had quite a few questions regarding this and what is a stable income arrangement. So most people may know it as paying an employee a salary, but per the Agricultural Wages Board it's termed a stable income arrangement. And that is where wages are paid in equal instalments regardless of the number of hours worked in each pay period. So therefore, on this system, overtime is not paid as you go along throughout the year. So they're not being paid overtime on a monthly basis. They're purely getting that set amount per month, that equal instalment throughout the year to assist with a bit of cash flow and budgeting. However, it's worth noting that at the end of the year, you require to use timesheets to calculate what your employee would have been due for their hours if they had been paid hourly as per the order. So you would need to look at the number of hours they had worked, if they had been charged at the hourly rate set by the Agricultural Wages Board, rather than an equal instalment stable income arrangement, how much money would they have been entitled to? And we'll look at an example of what this means and why you need to do this just now. So, if we take a look first to the bottom of the screen where we can see the example. So this is how you're calculating the amount that they would have been due if they were working hourly as per the order. So from the timesheets, this employee worked 13 weeks of 35 hours during the winter and 39 weeks of 40 hours in the summer. So £8.21 is the minimum wage that this employee is entitled to, again as per the Agricultural Wages Board. Before I explain this any further, I'm just going to highlight that the reason we're doing this is that although you don't need to pay overtime throughout the year, you may require to pay overtime in a lump sum at the end of the year, depending on what your employee is being paid as per their stable income arrangement, depending on how it links up to what they would have been paid hourly through the order. So you're really doing a wage check to then decide if your employee needs any more money on top of their stable income arrangement. So what we would do with this employee that's working 13 weeks of 35 hours. 35 hours are within, once an employee has worked with you for more than 26 continuous weeks, the overtime thresholds are either 8 hours a day or 39 hours in a week. So therefore, for those 13 weeks during the winter, the employee is entitled to no overtime. So therefore, we simply calculate 35 hours by 13 weeks and by £8.21 an hour, which is the minimum wage set by the Wages Board. And then we total that at the right-hand side. Save that there for the moment. And then we go on to look at the hours worked in the summer. So they worked 39 weeks of 40 hours. But therefore, that 40 hours a week is taking them above the standard working week of 39 hours. So therefore, 1 hour every week would be classed as overtime. So to begin with, we just work on the standard week of 39 hours. So we take 39 hours, they've worked 39 weeks in the summer, so we multiply 39 by 39 and again by £8.21 for the minimum wage, and we get a figure just short of 12,500. So again, we park that up for the moment. We then deal with that 1 hour a week, which classes as overtime. So that was 1 hour a week through the summer where the employee worked 39 weeks. The rate of pay then changes, however, as per the Agricultural Wages Board, overtime should be paid at 1.5 times that employee's minimum wage. So this employee has a minimum wage of £8.21, so therefore their overtime rate of payment is £12.32. So when we multiply that up, we've got £480. And when we add those three figures at the right-hand side together, we get a total of £16,703.44. And that is how much money the employee would have been paid if they had been paid hourly as per the order. So if we go back further up the slide, this employee is being paid £15,000 as per their stable income arrangement. So therefore, the salary or stable income arrangement amount that they have received is less than what they would have been paid through the order. So therefore, action is required. It's only if the salary or stable income arrangement amount received matches or is greater than the amount calculated from your sum that no action would be required. So therefore, as the employee's been paid £15,000, but their hours would have totalled a payment of £16,703.44 as per the order, then a lump sum of the difference would be paid at the end of the year. So therefore, this employee would be paid an extra £1,703.44. So this is an area that quite often causes confusion because people think they don't need to pay overtime on stable income arrangements. So you don't need to pay overtime explicitly in the way that many people think of paying overtime, but at the end of the year you do require to do a check to check that your employee is being paid what he would have been entitled to if he had been paid under the order. The Agricultural Wages Board guide for employers and employees is a fantastic resource to understand more about the stable income arrangement, and there is a link to the electronic version of that guide on the Farm Advisory Service Employing People website. What we'll now go on to look at very quickly then is criminal record checks. So this is a question that I have been asked in relation to if people have any concerns about a potential employee. Maybe it could come more moving forward following the end of the Brexit transition period. We're not sure what our workforce may be, and therefore some employers are concerned about what if they had doubts regarding any potential employees. What are their rights in relation to criminal record checks? And the answer is, for agricultural employers, you can request a basic criminal record check. So that is the lowest level criminal record check. You qualify for that one, you don't require for any of the higher up checks. But you can run this check. It's an online process and it costs £23 to do the check. And it can take up to 14 days to get the results. There's a link there regarding where you go. It's a gov.uk criminal record check website, but that link will also be on the Farm Advisory Service website. So another point that I particularly want to highlight is in relation to employers' liability insurance, which was covered in webinar 1. As employers, you're required to keep employers' liability insurance certificates for 40 years. Now, I know this seems like an excessive time, but the reason is that employees can claim for accidents that happened with you many years down the line. So take, for example, even in week 1 with you, your employee had an accident that affected their hand or their arm. If later in life they consider that accident to have a detrimental effect on their hand or arm that has then stopped them doing something else, they can come back with you with a claim. And therefore you must be able to show that you had valid insurance at the time of the accident. So therefore keep all certificates for 40 years. If you cannot provide details of the insurance cover that you had in place at the time of incident or injury, then the company can become liable to indemnify the portion of that claim for which they can't provide details of a valid insurance policy for. So this could, for any businesses that this could affect, this could be a particularly nasty situation. So it really is worth just keeping these certificates in a filing cabinet somewhere, purely to protect yourselves. We're now going to move on to a different topic and look at pensions for seasonal workers. So webinar 1 looked a lot at auto-enrolment and the duties of employers to enrol workers onto a pension scheme. However, there then comes the issue with seasonal workers, who will often be working long hours and therefore totting up quite a lot of earnings, and therefore may meet the earnings criteria for pension auto-enrolment. However, they may only be with you for a short time. So it begs the question, do you have to go through the pensions auto-enrolment process? And the answer is never really clear-cut, but it is worth noting that you can postpone auto-enrolment if you know your employees will be with you for less than 3 months. So if they are seasonal workers that are there for less than 3 months, then the easiest way to deal with it would be to postpone the auto-enrolment. And during any staff member's period of postponement, you won't need to put them into a pension scheme unless they ask to be put into one. So that would save you, a bit of time and effort. But that obviously only applies if they will be with you for less than 3 months. So if they are in, maybe they're still seasonal, but they're there for a little bit more than 3 months, then that's where it can get difficult. And at that point, I would recommend consulting the pensions regulator for some more information there. The second topic within pensions that we're going to look at is how pensions relate to those that are out with the auto-enrolment criteria. So situations do arise where employees ask to be included in pension schemes, even if they do not meet the age and earnings criteria. So the age criteria is aged between 22 and the state pension age and earning at least £10,000 a year before tax. However, even if employees are not meeting those, they can ask to be added into a pension scheme. And if they come and explicitly ask, as an employer, you are required to add them to the pension scheme. And there are different rules as to regarding whether or not you need to make employers' contributions to that pension. And we'll look at that on the next page here. So, you're required to make earnings contributions if they are earning above £10,000 a year before tax, are aged between 16 to 21 or are the state pension age. So that is really those employees that are meeting the earnings criteria, but they're not meeting the age criteria, but they came to ask you to be included in a pension scheme. So if they did that, then yes, you do need to make contributions. If they are aged between 16 and 74, and they earn between £6,136 up to £10,000 a year, then you also require to make pension contributions for those people. So there's almost a second earnings category there brought in for those people that specifically ask to be added to a pension scheme. However, you don't need to make contributions if your employees don't meet that £6,136 a year earnings and are aged between 16 and 74. So almost for situations where employees are specifically asking to be added to pension schemes, £6,136 is a kind of key figure to remember in relation to earnings. Okay, so we'll just round up then with some important dates. So the 1st of April 2020 is a date to remember, as that is the date that the Agricultural Wages Board guidance will change. It annually refreshes at that date, and this year there are changes coming to minimum wage and holiday entitlement for those who work varying numbers of days each week. So that was covered in webinar 1, if anybody is interested in finding out more of that. But the 1st of April 2020 is the date effective from, and the new guidance will be coming out very shortly on that to allow you to get up to speed with what changes will be coming into effect. The 30th of June 2021 is also a key date as it's the deadline for the EU settlement scheme. And the EU settlement scheme is for those EU, EEA or Swiss citizens who are currently working in the UK and wish to live permanently in the UK. They're required to apply to that scheme. But again, that was covered in webinar 1, and it is also, there's more web links and information on the Farm Advisory Service website. But those are just 2 important dates to note as we round up today's webinar. So on that note, I would like to thank you very much for listening to this Farm Advisory Service webinar. As I have said throughout the webinar, there's a range of resources on employing people on the Employing People section of the Farm Advisory Service website, and that website is www.fas.scot. So some of the materials there are templates that you can download and use, practical guides, videos and web links to lots of other useful information, and there'll also be a podcast with an accountant going up shortly. And what we will also get up onto the website shortly is a recording of both this webinar and last week's webinar, which was how to employ and who should be employed and how to employ them. And if you've got any further questions, then the Farm Advisory Service helpline can also be used to get free over the phone advice. So at this point, I'd just like to thank you all very much for listening to this webinar, and please consult the supporting information on the website for other information regarding employing people. Thank you very much.